Hi there, welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Statistics Canada says retail sales rose 1.1% in January compared to the month before, with sales at motor vehicle and parts dealers leading those gains. The strength was broad-based, with increases in all provinces, including a nearly 1% rise in Ontario. Looking ahead, an early estimate points to a 0.9% gain in February, suggesting consumer spending is holding up despite economic uncertainty. Iran is pressing ahead with attacks on Gulf Arab states, even after Israel signaled it would stop targeting the Islamic Republic's energy infrastructure. The war has killed more than 4,200 people across the region and has brought shipping through the Strait of Hormuz to a near standstill. Iran's attacks on critical energy sites have eased from a peak earlier this week, yet crude prices have maintained their rise after closing yesterday at the highest since mid-2022. And Kraft Heinz is making a multi-million-dollar investment in its Montreal factory. The packaged food giant will invest $250 million to modernize equipment and infrastructure at the plant as it looks to ramp up production and expand products to meet demand. The company has been looking to revive demand under its new CEO after pausing plans to split into two. We're keeping a close eye on the TSX today. It is down by 1.1%. This has erased basically all its gains since the beginning of the year as a sharp sell-off is weighing on the TSX. So we're continuing to watch this today, watching it fall even further this week. If we take a look at U.S. markets, it seems as though it's a little strained as well today, given everything that's happening in the Middle East, still affecting markets south of the border, especially the NASDAQ, which is down by more than a full percentage point. And we'll take a quick look at the price of oil as well. WTI is up almost 3% at the moment. Look at that spike since the beginning of March. Energy prices are still vulnerable to volatility due to the war in Iran as the Strait of Hormuz continues to be basically at a standstill. But our next guest says there are two other major factors in play causing this volatile period. Here to explain what they are is Brian Mulberry, Chief Market Strategist at Zacks Investment Management. It's good to have you join us. Thanks so much.
Thank you.
So what are the other two factors?
Well, private credit is the one that comes up more often than not, especially in the last week, as we see more of a risk-off rotation, especially from retail investors. They're just concerned about asset valuations and volatility. And private credit has some concerns, no doubt. But the biggest one is there are some structures in there that feel very similar to the global financial crisis and what happened in 2008. And what we're finding is that geopolitical tension is just exacerbating some of those fears. We're here to say that not everything is bad or wrong with private credit. It's just difficult to know what you own inside of some of those structures, and that lack of transparency only feeds into more fear. And then the other one is AI, and AI spending has now turned into AI anxiety. When is all of this, hundreds of billions of dollars of CapEx spending going to come back to the Mag 7 companies? And when it does return in the form of revenue, will it be profitable after spending so much money? Those two other concerns, in addition to energy prices, are really weighing on the market right now.
So let's talk about private credit. That's the first one you mentioned. Can you talk about some of the key events that drove volatility within private credit?
Well, 6 months ago, we had a couple of bankruptcies, and they were kind of tied to the automotive segment. First Brands and Tricolor went bankrupt, and they were actually a couple of the bigger sources of the paper that private credit was using in order to drive really large yields. And so it turns out those companies going bankrupt, obviously it means that the collateral, the loans that were being used to collateralize into these private credit vehicles were worth nothing. And so that has an impact impact on obviously the people that are invested in those types of funds. So that was the first warning shot at the time. If you remember, JP Morgan talked about cockroaches when you turn the light on. That's just the first few. And so the concern has been there's more bad paper or lower quality loans being used as collateral inside these private credit structures. The next step was JP Morgan last week wrote down a lot of the asset values that they were being used as collateral for things like data center loans, and those are in turn being collateralized in private credit. So that means that, what the private credit companies have been saying is that there's no problem, all the assets are fine, and a dollar is still worth a dollar isn't necessarily true. Now, we've kind of known this because the value of the BDCs that are more of the publicly traded issues are down about 30%. Now you had JP Morgan write down their collateral by about 30%. So people are just showing their concerns, and we understand that, but it's also creating a bit of a wave of fear and fear-based selling in the market at this time.
So what would need to happen to stabilize the private credit sector?
I think just some education. There are some packages that look similar to what happened in 2008, but it's not the same. Remember, those mortgage-backed securities in the global financial crisis were everywhere, and they were also levered up 20 to 40 times. And so that contagion really was very widespread. Almost every bank had some type of exposure to it, and it was a very big market. Right now in private credit, the global, I think, asset value is around $3 trillion. It's about $1.8 trillion here in the Western Hemisphere, and the leverage is only 3 to 4 times. So the exposure to any contagion event is much smaller on the front end than what happened back in the global financial crisis. So that's point number one. Point number two, there are some higher quality assets that are backing some of these issues. There's no doubt about that. However, bankruptcies have been on the rise, and that certainly would have some impact on the value of these. So it's not, total catastrophe. It's not like we're going to get marked down to zero like what happened in 2008, but it's also not 100% fine. It's probably somewhere in the middle is the most reasonable answer, but the fear-based selling is certainly having an impact on some of these managers like Morgan Stanley and Cliffwater have been writing about it in the last week as well.
No kidding. Okay, so on the flip side, we're talking about AI as well, and you've warned things could turn again if investors believe that companies have really overspent on AI, which seems as though investors are cautious of that at the moment. How real is that risk to overbuild?
Well, that's really the concern. I mean, in the moment right now, the demand for AI is resulting in a lack of computing power. So that's why we need to spend all of this money and build data centers that are going to have more computing power, more inference to power the next generation of agents and bots and things of that nature. So the demand is there to support the spending that these hyperscalers are doing, $660 billion just in 2026 alone. The concern would be if something happens, and it could be a wave of innovation that renders the lack of compute a moot point, or if we have some weakness in the economy and somebody pulls away from those spending commitments, then a lot of that growth that's been priced into the Western market simply goes away. So if Microsoft, that's going to build 100 data centers in the next few years, says we only need 50, then the amount of money that they're spending drops by half. And what we're seeing is a broadening in earnings across other sectors that are directly involved in the construction of these very large facilities. Then their earnings turn negative. Things like John Deere, Caterpillar, and General Dynamics, those firms that are going to be necessary if you're going to build these many large structures, they're benefiting right now from that spending. It could turn into a negative if that spending stops.
Just before we wrap up here, I want to ask you about oil, because obviously that's another factor that's influencing the volatility we're seeing right now. If the price of oil stays elevated for longer, what sectors do you think will benefit from that, and which ones will be hurt from that?
Well, refiners benefit from the high price of oil. So you want to own something like Chevron, Conoco, Phillips, something along those lines, because they benefit from the higher raw material costs. They get to charge more for the finished product on the throughput, if you will. So the hedge against higher oil prices is to own those types of energy stocks. Unfortunately, On the bad side, it makes the cost of everything go up. So as fuel prices rise, it also means things like fertilizer become more expensive as well, just as we're getting into the planting season. So it does have a very inflationary impact downstream of almost everything in the economy. So if oil prices stay this high going into the summer months, then a lot of this market is going to have to get repriced in terms of what we thought about growth, and in particular earnings growth in many sectors.
Okay, so much to go over, so little time. Brian Mulberry, Chief Market Strategist at Zacks Investment Management. Appreciate you joining us. Thanks so much. Statistics Canada has reported retail in Canada for January. It was up 1.1%. We've got more on those numbers right after the break. Canada's retail sales rose 1.1% in January, driven by motor vehicle and parts dealers, but the gain came in slightly below expectations. So joining us for more on this is Carl Gomez, Chief Economist and EVP Research at Centurion Asset Management. It's good to have you join us. Thanks so much.
Thanks. Nice to be here.
What is your read on today's numbers? Like, does the slightly softer gain that we're seeing change the narrative around what Canadian consumers are spending right now?
Actually, things came in a little bit softer, but this is actually a surprisingly resilient report. I mean, increasing 1.1%, still, even though it was slightly below expectations, it was, relatively strong. There was strength, across the board. 6 out of 9 subsectors actually saw increases. Core retail sales was very robust, and that's core excluding autos and gas, 0.9%. And the flash estimate for February looks like it's also going to be continuing growth at about 0.9%. All in all, I would say this is a surprisingly strong result in, signs of showing consumer resilience amidst a lot of headwinds.
Okay, let's dive into that a little further. You say surprisingly strong. Obviously, yeah, there's a lot happening right now, particularly with Canada's economy, that you would think maybe people would be trying to rein it in a bit. Is that what you mean? Can you explain just why this is so surprising for you?
100%. I mean, if we think about all the headwinds, the uncertainty obviously in the political environment with, trade and tariffs, now we have the Middle East conflict. Certainly these numbers don't reflect that because we're looking a little bit, backwards in terms of January, February. But even before that, weak job growth, a correction in the housing market going on. You look at the sentiment and consumers are feeling very weary, but I always say, pay attention to what consumers do, not necessarily what they say. And when you look at the numbers here, I mean, people are still spending on, anything from, cars to health, personal care items, to just general sporting goods and things like that. So consumers are still actually in the game. And, when you add up the numbers, especially from, a good handoff in the fourth quarter, consumers look like they will actually give a, surprisingly good contribution to GDP growth in Q1. Basically kept the consumers kept the economy out of recession last year with very strong spending. And, when you're adding things up, and we don't have the whole picture for March, but basically when you look at things right now, consumer spending will be as strong as it was in the second quarter of 2025. So a positive story for the consumers considering all the headwinds that are out there.
You mentioned consumers and spending really kept us out of a recession so far. I wonder how much of that has to do with the kind of buy local, buy Canada trend that we've been seeing ever since this trade war really got underway.
Good point. I mean, consumers are armed up with, considerable savings, and, they are feeling patriotic. And so they are spending, definitely, to support goods. But, when I look across the board here, there is definitely a buy Canada sentiment. But there's also a little bit of a sentiment that consumers are using, what I would call retail therapy a little bit, buy things like sporting goods, dinners out. And this is basically good spending, so we don't know on services, but we also know in terms of services spending that people are spending at restaurants. I just got back from March break travel, lots of Canadians traveling, spending on experiences, maybe not so much in the United States, but certainly in the Caribbean and other places. I think this is, a situation where consumers are still in the game, drawing upon the savings where they have it, for other wealthier Canadians who have ample equity in housing and stocks. drawing upon that to continue to spend despite, weak income growth overall. So I think consumers are there. My concern is longer term. Will consumers be able to keep up spending the way they are without a commensurate sort of increase in job growth? And we also heard news more recently about population growth coming down. Fewer bodies means fewer aggregate spending, all else equal. So, there are a lot of headwinds. And now I think, with the Middle East conflict and the impact of the pricing at the pumps, more and more people are going to be spending more of their income towards gas purchases as, depending how long this increase goes, that could cut away on discretionary spending as well. So given all of those sort of headwinds, I remain surprised that the Canadian consumer is as resilient as they are.
That's a good point. And as you say, maybe looking ahead, it might not be the case. Obviously, an estimate for February shows a gain as well. But as you mentioned, with all those factors in place and people spending, but maybe not having the same income, how long is that going to continue, right? And I wonder, what does this signal for the Bank of Canada for further rate decisions?
Well, it's interesting because if you look at the news today, maybe not as much trading off of the retail sales report, but, a little bit on oil prices and the risk on inflation. Bond yields continue to kind of push higher. The 5-year bond yields at a 52-week high. 10-year, the critical 10-year benchmark 10-year bond yield is also moving up higher. And if you look at where financial markets are pricing things in, they continue to lean towards a rate increase for the Bank of Canada. Now it's starting to move towards July instead of the end of the year. So there's a bit of a push and a pull here. Consumers may not be holding up the economy, but because they are, that actually does give the room to the Bank of Canada if they see inflation as a risk to raise rates. So I think that's probably why financial markets are kind of pricing that in. It's a tug of war between the state of the economy and how consumers play out and how this inflationary backdrop with higher energy prices flows through to the rest of the economy. But the other thing I also, think about here is that Canada, although it's not, as much of the oil producing country as it was previously, there's some, consolidation that's happened in the energy sector. We are still a net energy exporter. So oil shocks tend to be positive on incomes generally across the board for Canada. And so that gives some scope to the fact that the Bank of Canada doesn't need to be necessarily as accommodative. The real risk here is just on inflation and whether there's a flow through, depending on how long this conflict is in the Middle East, to consumer prices. But for now, consumers are still in the game. And if we just, see where things are leading for the first quarter, it's still a, positive environment. I think the takeaway here is that rate cuts, if anybody was hoping for them, are off the table.
Okay, we'll leave it there. Carl Gomez, Chief Economist and EVP Research at Centurion Asset Management. Thanks so much for joining us. Appreciate it. Coming up, we're talking to Jason Simpson, CEO of Orla Mining, on its fourth quarter report right after the break. Stay with us. Shares of Canadian-based Orla Mining are up today after it reported record gold productions for its fourth quarter, a beat in revenue, and reported growth potential in its Musselwhite and Nevada mining locations, and the green light to continue expansion in its Mexico asset. Here to discuss its latest quarter report and the company's future is Jason Simpson, CEO of Orla Mining. Welcome. It's good to have you join us.
Thank you, Lindsay. Thank you to BNN for hosting Orla Mining once again.
Of course. So Orla surpassed 300,000 ounces of gold production for the first time. That was reported in this latest earnings. How significant is that milestone for your long-term profile as well?
Yeah, really the 300,000 ounce mark that we achieved last year is part of the journey that we've been on since the beginning at Orla. Our conviction is that by 2028 we can get to 500,000 ounces, and we're pursuing 1 million ounces by the end of the decade. So the 300,000 ounce mark was important in 2025, and we've guided to a midpoint of guidance in 2026 to 350,000 ounces. So as I like to say, that takes us part of the way on the journey for Orla Mining.
There's a lot of different projects to talk about. So we'll start with the South Railroad project, which is showing some results. How critical is this asset for Orla's next phase? And what are you expecting in terms of future numbers?
Yeah, that's the important first asset to talk about this year, because we're beginning construction at that mine this year, continue through next, and it'll represent our third mine in the Orla portfolio. So that'll be the focus of our attention over the next 2 years. It'll add about 130,000 ounces per annum of gold production, importantly at very high margins. Another open pit heap leach, similar to the operation we have in Mexico. These open pit heap leaches are tremendously cash generative. The Mexican asset is what enabled us to graduate into Nevada and then eventually Canada last year. And so we look forward to bringing it online and adding to the annual production and cash generation of the company.
Let's talk about the Musselwhite acquisition. How has that improved production and geographic exposure?
Musselwhite was an absolutely transformative acquisition for us. It more than doubled our production, and as exemplified in our results, is now our largest mine and really is the anchor of our business. And so it will continue to produce over 200,000 ounces a year, added to the 115 that we produce in Mexico, midpoint of guidance this year. That's what takes us to the 350 midpoint in 2026. The interesting thing about the Canadian asset is that we believe that we could do two things there. One is extend mine life considerably, and the second is that we had many years to go and a lot more gold to harvest. And last year we demonstrated that. From underground, we clearly had indications and will be able to increase for many years the lifespan of Musselwhite. But from surface, we were able to push that gold mineralization out for 2 more kilometers, so effectively taking us out for many decades of cash generation from our Canadian asset.
There was also some new discoveries at the Musselwhite asset as well. Is that right? 2 kilometers below the original mine?
Yeah, it's actually an extension of the existing mine. So that mine has been producing through the great employees and stakeholders in that community for over 25 years. It's produced 6 million ounces of gold. When we acquired it from Newmont, we knew that we were acquiring a little over 1 million ounces, but we believed that it could continue even further than the 6 years that Newmont had outlined. And so we demonstrated that last year. Drilling holes from surface some 2 kilometers away from the last mine working, we were able to intercept that gold formation that continues. So what does that mean for Orla investors? If 6 years and 6 kilometers of mining over the last 26 years, 6 kilometers has generated 6 million ounces of gold. We just added 2 more, so we've tripled the potential resource at Musselwhite. Again, emphasizing our conviction that we'll be there for a long time harvesting gold out of the Musselwhite deposit. The other discoveries are surrounding the deposit. There's gold that we've discovered on surface, almost unbelievably for such a legendary camp.
What's the cost, though, of continuing to mine in those deeper areas?
Yeah, that's an important feature of a Canadian underground mine. It is a different cost than an open pit heap leach mine like we have in Mexico and our building in Nevada. So certainly it's a different cost profile, but we believe we also have a strategy to reduce the costs. There's really 2 elements we'll focus on. More production clearly drops the cost per ounce, and we've already demonstrated that we're going to be able to deliver more and reduce the cost that way. But also by improving some of the infrastructure at the site, we actually believe we can reduce the total cost of the operation. But we're always going to have a remote fly-in, fly-out operation, an underground mine, and from that very nature, it will be one of our higher cost mines. But when you aggregate that with the 2 open pit heap leaches, we're comfortably into the first quartile of costs, and predictably at today's gold prices generating significant cash from all of our operations.
We are almost out of time, but I did want to ask you, just in terms of the geopolitical factors around the world right now that might be impacting your company. What we're seeing is the price of gold obviously has been dropping. How do you manage any kind of risks associated with things like that?
Yeah, so I'll answer that question from two perspectives. One is the revenue that we generate. I think most gold miners and my peers are comfortable in these gold prices. We are building a company that would be resilient at gold prices thousands of dollars lower than what it is today. So we would certainly like to maximize the revenue that we're generating and increase the value that way. But at $4,500 gold or $5,000 gold, we're making tremendous profits and will have a company that survives at all parts of the gold cycle. On the cost side of things, and I've gotten a lot of questions about our fuel exposure and so on. Listen, wars are inflationary, tariffs are inflationary, and so we are not immune to inflation. However, each company has different exposure to it, and we use fuel as an example. In our operations in Mexico and Canada, the majority of our fuel is used in Mexico. We only have about a $25 million U.S. exposure to fuel prices. So therefore, in that example, you can see that Orla is not particularly exposed for fuel inflation and so on. So we are extremely comfortable with our cost of our operations to be able to produce free cash flow, as demonstrated in our results last night at all gold prices and in any macro inflationary environment.
Okay, we'll have to leave it there. Jason Simpson, CEO of Orla Mining, appreciate you joining us today. Thanks so much.
Thank you.
A split between gold and crude is sending a message about the Iran war. We will break down what that could mean right after this. Retail sales across the country saw an increase in January. Data from StatsCan shows receipts rose 1.1% compared to the month before, led by higher sales at motor vehicle and parts dealers. Sales at sporting goods and general merchandise retailers also saw an increase. On the downside, food and beverage retailers posted the largest drop. In a flash estimate for February, meanwhile, StatsCan predicts sales rose 0.9%. The government of Ontario is moving to protect ticket buyers by proposing changes to the Ticket Sales Act. The amendments would cap ticket resale prices and make it illegal to resell tickets for live events in Ontario for more than their original cost. There has been long-standing concerns about inflated resale ticket prices, and in a response sent to BNN Bloomberg, StubHub says resale accounts for only 9% of all event tickets sold, adding that such a move will hand monopolies like Ticketmaster a win and will hurt fans with more fraud. U.S.-based Ecolab has agreed to buy private Canadian firm Coolit Systems in one of the biggest ever Canadian tech takeovers. The $4.75 billion all-cash deal is expected to close later this year, and it comes amid the boom of data center construction to support computing demand. Coolit develops cooling technology for AI data centers. We are watching the TSX closely today. It's down by 1.3% at the moment, pretty much erasing all the gains that the index has seen since the beginning of the year. Obviously, this war in Iran, in the Middle East, influencing things heavily as we move forward, including most sectors on the TSX. And U.S. markets also trading down today throughout the day. The S&P 500, the Dow Jones, and the NASDAQ are all down at the moment. Well, volatility in both gold and oil is persisting, suggesting these once defensive trades have turned overstretched. We're looking at how those pressures could spill over as the Iran conflict evolves. And so for more on this, let's bring in Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Mike, it's good to have you join us. How should we be interpreting the divergence between gold's pullback and crude's surge since the outbreak of this conflict?
Right, gold basically front-run this. Gold was up 65% last year, the best year since 1979 in a non-inflationary environment, 3% now, versus our last versus 15%. Then was warning us something's happened. Now something's happened. So buy the rumor, sell the facts kicked in. The key thing that happened with gold is it just went up too much, and it turned from what is a store value, which typically trades at a lower volatility in the stock market, to right now 180-day volatility on gold is more than 2 times the S&P 500. That's not a store value. That's a conversion. That's a shift to a speculative risk asset, and we're seeing what happens. But I think part of that is we're seeing a spike in bond yields and potential for rates to go up despite the world turning to go to global recession. And I think gold's also looking forward to a potential secure Strait of Hormuz, meaning how much worse is it going to get? I think the U.S. and Israeli forces are probably going to just keep pounding until submission, until Iran can no longer harass its neighbors in shipping. And gold might be looking back to that safer world. Yet crude oil still has to worry about the weekend. But by the time we get to Monday, if there's not a lot of harassment from the Iranian forces, crude oil's setting up for a decent collapse at some point here.
What makes you see pump and dump risks for both gold and oil in 2026?
I'm glad you went there. Well, first it happened in 2008, but it's already happened this year. In January, natural gas, U.S. natural gas was up 100%. Now it's 15%. At its peak, silver this year was up 63%. Now it's down. At its peak, copper was up about 15%. Now it's down. You see the trend there? This is happening in a lot of commodities, mostly the elastic commodities. Industrial metals are really getting hammered as they point onto the world going lower. But the key thing to think about here is copper right now on the year is down about 5%. That about matches the S&P 500. See the problem? It's the same trade. Everything's a trade now. Same trade. All that volatility from precious metals and oil's trickling over the stock market, yet volatility in the stock market is still very low. I'll give you one metric. 60-day volatility is actually down about 10% on the year, and it's running about half of what it was at this same date in 2008.
Are we seeing maybe a reset in some sectors? Like, has the conflict in Iran already kind of triggered a reset for both gold, silver, and oil, do you think?
Exactly. Well, oil is the front runner right now, but oil is typically its own worst enemy. It pumps up a lot, brings on supply, reduces demand, tilts the world towards global recession, and goes back down. So I see a 2008 type scenario sticking in here. The thing is, it's much worse. In 2008, to its high, crude oil was up about 50%. Right now, Brent's up more than 50%, and it's up almost at its peak, it was up 100%. WTI is still up about 60%, so it's much worse. Even retail gasoline is up much more than it was in 2000, and diesel's up higher. So that pressure on consumers and the economy is much worse. So we need this to go lower. But the bottom line for all consumers, consumer sentiment was waning before this event. Now it's psychological, and the two things to pressure consumer sentiment the most is gasoline prices going up and the stock market going down.
That's kind of what we're seeing at the moment. Okay, Bloomberg's Mike McGlone with the latest there. Mike, thanks so much for joining us. Appreciate it. Well, if you are fed up with sky-high resale prices for tickets, you're definitely not alone. Ontario has officially launched a proposal aimed at cracking down on gouging. We'll break down what that means for you right after this. The Ontario government is moving to cap ticket resale prices at their original value 7 years after scrapping similar rules. The proposed changes would make it illegal to resell tickets for concerts, sports, and live events above face value, while also tightening rules on fake tickets and unfair service fees. Joining us now is Stephen Crawford, Ontario's Minister of Public and Business Service Delivery. It's good to have you join us, Minister. Thanks so much.
Well, good afternoon, and thank you for having me on the show. First day of spring.
First day of spring. As we mentioned in the lead, the Ford government scrapped a similar legislation back in 2019, saying that it was unenforceable. So what's different now?
Yeah, well, thanks again for having me. And our legislation today goes much further than what was available before. So we are now capping the resale ticket marketplace at face value. So people will be able to resell their tickets through various vendors that we have in the marketplace here in Ontario, but they will not be able to sell it more than the face value and, of course, the fees that are associated with that as well. So that'll be enforced as soon as we pass the legislation, assuming it passes sometime this spring, but it will be fast approaching, and we're excited to announce this because we believe this will make sporting and cultural events here in Ontario much more affordable for families and people that are looking to go out and enjoy some of these events.
It's obviously been a problem for some time, the sky-high prices of resale tickets. But again, like, how are you actually going to enforce it and make sure that they're not being resold on third-party websites?
Yeah, so we're going to have a stronger compliance division. It all falls under my ministry at the Ministry of Public and Business Service Delivery and Procurement. We're going to put additional resources into enforcement. We will also be consulting to see whether we should increase the fines for people that are taking advantage of the system right now. And I think that that's going to be an important part of this as well. So it's stronger enforcement, more visibility, more consumer awareness to legitimate sites.
So increasing the fines so far isn't part of the initial legislation.
That's to be determined. The initial fees right now are 10,000, but we are looking at increasing that to 25 potentially.
We do have a comment from StubHub today. I'm going to pull it up on the screen so that our viewers can read it. It says StubHub, it says Ticketmaster Live Nation just walked away from an antitrust trial in the U.S. with a slap on the wrist and its monopoly intact. Now Ontario wants to reward them by targeting their competition with a bill straight out of Ticketmaster's playbook. Instead of handing the company that brags about robbing fans blind a win and enacting a policy that hurts fans with 4 times more fraud, leaders should focus on real reform that actually reins in Ticketmaster's prices. So for its part, Ticketmaster has said it doesn't actually set prices, but these are some strong words coming from StubHub, Minister, in regards to Ontario rewarding Ticketmaster. What do you make about these comments?
Well, I wouldn't view it that way at all. What we're focused on is helping the people of Ontario be able to afford family, cultural, sporting events. We know what happened with the Taylor Swift concert a year or so ago. We know what happened with the Jays World Series tickets, where people were selling them for 300%, 400%, 500% above market value, and that's just simply unacceptable. And we know that StubHub and companies like that, listen, they're legitimate resellers. We welcome them here to work in Ontario, but they're not going to be able to take advantage of people. And if they are in this market, and we hope they will be, I'm sure they will continue to be, they'll be able to charge a fee on those tickets, but they'll have to change their business operations to adapt to the market. I think we're also going to be sending a signal to a lot of the illegal bots that are operating in Ontario right now, which unfortunately have always tried to get ahead of the systems in place to prevent that. And I think a lot of the bots that are coming in right now and buying high demand tickets very, very early, taking advantage of the people of Ontario, are going to move to other marketplaces that are less regulated, because there's no market in Ontario. There will be no market in Ontario anymore to resell those tickets at extreme high prices. So we think we're going to help clean up the market and make it more fair for the people of Ontario.
SeatGeek has also warned that this could make tickets more expensive. I don't know if you've heard what SeatGeek has had to say. It says that this shifts costs in a way that are harder to see, whether through higher base prices or fees buried elsewhere in the transaction. Do you agree with that?
Absolutely not. The ticket prices, first of all, are set by the artists. So let's be very clear on that. So any artist, be it Taylor Swift or U2 or the Rolling Stones, whoever are playing in the province of Ontario, they sit down and set up the ticket prices. So StubHub and SeatGeek and other ticket resellers simply make a profit on the spread between what the ticket was originally face value and what the new market price will be. So I don't agree with that whatsoever.
We've seen fans also getting scammed by buying resold tickets on platforms like Facebook, Marketplaces. You mentioned Marketplace, I think. But could the government explore protections that lets consumers recover their money if they e-transfer someone who never sends the tickets?
Well, we have a very strong consumer protection division here in my ministry. We'll continue to enforce that. But, we really believe that the people of Ontario, if they are reselling their tickets, they should go through legitimate ticket sellers. And you've mentioned a few of the names of those companies that are operating in the province of Ontario. And we have a very fair, safe, and transparent marketplace for secondhand sales tickets and resale tickets right here in the province of Ontario. And we would encourage all Ontarians to go through that marketplace. And our ministry will certainly continue our education awareness program to make sure Ontarians are aware of that.
So I take your point, as you were mentioning at the beginning of this conversation, your government is exploring higher penalty fees, but that's not going to be in this initial legislation. Do you not think it should be, to really enforce this and make people not want to actually try to go around the legislation that you're introducing?
Well, first of all, there's already a fine there right now. But secondly,
but a higher
we are going
fine.
to consult. We want to talk to people. We want to talk to companies and see how the marketplace handles this. But like I said, we are very willing to take stricter regulations and stricter enforcement should that be needed. We're very open-minded on that. We'll see how the marketplace evolves on this. But having said that, again, we're very confident this is great news for the people of Ontario, who are going to be able to afford, finally, going to some of these high-demand events, and they want to take their families and go with their couple kids to a concert or a hockey game. I think this will put them in a better position to be able to do that.
When will this cap come into effect?
The cap will come into effect, assuming the legislation is passed. It'll come into effect right away. So that will be very, very soon, certainly this spring and before the FIFA events that are expected in the early summer.
Okay. Stephen Crawford, Ontario's Minister of Public and Business Service Delivery. Thanks so much for joining us today, Minister. Appreciate your time.
My pleasure. Thank you very much.
Still ahead, today's market movers with Bloomberg's Matthew Griffin right after this.
By lies, trapping Canadians.
She's a 19-year-old girl.
W5 uncovers a crime syndicate hunting for traffickers.
They just asked me to find people for them.
Watch W5 Saturday at 7 on CTV and Crave.
Welcome back. For some movers south of the border now, we are joined by Bloomberg Equities reporter Matthew Griffin. Matthew, it's good to see you. Thanks for joining us. We're going to start with Mosaic because shares are sliding for that company. What's going on there?
Yes, well, Lindsay, thank you for having me on. And Mosaic is falling today after the fertilizer company's stock was cut to a hold equivalent rating at Bank of America. Now, what the analysts there see going on is input costs rising for this company as a result of the war in Iran. They are a large buyer of products like ammonia and sulfur. They're both made from petrochemicals, so their prices go up when energy prices rise. And they're also largely produced in the Middle East, or a large chunk of that supply comes from the Middle East. So you get kind of a double whammy there as conflict hits the region. I think the really interesting thing here is the divergence that's happened between Mosaic and its peers during the war. So you look at Mosaic, again, facing some cost pressures. Their shares now down around 13% since the war broke out. But look elsewhere in the industry at CF Industries. That's a company with a lot of operations that sit a little bit earlier on in the supply chain. They're actually a major producer of ammonia. And so they benefit when those prices go up. Their shares up nearly 30% this month, and they just keep hitting record highs.
You're also watching Gemini Space Station. This company hit hard after a plunge in crypto. Why is that?
Yes, so Gemini selling off today after what I would call a mixed earnings report, revenue higher than expected, but a wider than expected loss. But you're absolutely right that really the reason for the recent share decline, and probably the decline today, is that nothing this company can report can change the fact that the crypto world has changed since they went public in September. So the stock's down now around 80% since then. You've had Bitcoin sliding this year, really sliding since October, and trading sideways during the war, even though it hasn't been hit as hard as some other assets. So this company has tried a lot to make up for the hit to revenue that happens for a crypto exchange when prices fall. They're slashing their workforce. They're cutting back from certain parts of the world where they're facing strong competition. But again, nothing they can do can change that fundamental story. You look at what analysts were saying after this report, Truist saying numbers, revenue estimates are simply going to have to come down on Wall Street, and there really isn't justification for the stock's valuation right now. So again, the numbers themselves today were not that bad relative to expectations, but it seems like investors looking at the broader context here just don't have faith in this stock.
You're also watching FedEx. It's been an interesting week for this company. Those shares surging. They're up about almost 2% at the moment as investors cheer resilient demand and higher profit forecast. Tell us more.
Yes, so FedEx, this is a stock I have been watching closely during the war, and as have a lot of people on Wall Street. They're seen as an economic bellwether because they move goods for consumers, for companies in a lot of industries around the world. And so when you have demand, for example, if it starts to take a hit because of higher oil prices, any squeeze on the economy, that's going to show up first for companies like this. And so far, what we've heard from management has been pretty heartening. They see normal demand demand trends in March. They don't see a direct hit to their business through things like higher fuel costs, through disruptions to the network. They can, for example, pass those fuel costs on to customers, but they are watching the economic impact, that sort of second order effect of the war, of the surge in energy. Definitely not a company that's out of the woods, but investors hearing good things so far. And you also had signs that the company itself is executing well. They raised their profit outlook for the year. They are on track for $1 billion this year in cost savings as they combine their ground and air freight networks. So it's a company that seems to be firing on all cylinders in the face of some pretty serious headwinds. Shares were up as much as more than 7% today, best day since May. You've had the broader market sliding, though, so they're still just barely clinging on to gains.
Okay, we will leave it there. So interesting. Bloomberg's Matthew Griffin joining us live. Matthew, thanks so much for breaking down those companies.
Thanks for having me. Have a great weekend.
You too. We're going to take another quick check on the markets here before we wrap up for the day. Watching the TSX closely, it's down by 1.2%. Obviously, the sharp sell-off in gold really affecting the TSX here. Gold is set for its worst week in 4 decades in terms of prices. And obviously, the gold and mining stocks on the TSX being dragging down the index even further. You can see gold down by 0.6% at the moment. It's been falling all week. We'll take a quick check on the U.S. markets as well before we wrap up here. They're trading down today as well. Investors very wary, very cautious about what's happening in the Middle East, and we are continuing to watch that as well. That wraps up this edition of Trading Day. Thanks so much for watching.